Welcome back to the channel. As always, if you are copy trading, you are an absolute moron and you deserve to lose all your money. And with that out of the way, I'm going to speak today about a stock called Targa Resources, ticker TRGP. If we have a quick look at what these guys do, essentially they are a midstream company. So they own, operate, and acquire a portfolio of domestic infrastructure assets in North America. So they focus on gathering and processing, right, and then putting out their uh, distilled products of natural gas. Okay, they focus primarily on the Permian Basin, which looking is looking like one of the highest quality locations in the United States for production of these materials. I started looking at this stock because there is increased demand for energy due to AI and data centers. And some of the stocks that I've looked at in the past, for example, were Oklo, uh, that is developing small nuclear reactors to meet these demands. But as you can see, stocks like this have taken a nosedive recently. It is still experimental technology, and there's going to be bumps in the road. In the meantime, companies like Targa, you can see that yes, well, there has been a little bit of a pullback lately. I think that is really driven by the chaos that we have seen in the market, but not really the actual fundamental performance of the company. Now, when we look at the sector as a whole that these guys compete with, this company stands out due to two things. One, their vertical integration. So they have the ability to handle multiple stages of the value chain, right? So not only the processing and refining, but also the marketing and distribution. And then the second is that they specialize on NGLs. So we'll come to this a little bit later, but unlike other players that focus on other type of material like oil, these guys are very much focused on gas. Now, obviously, we saw big growth curve here over 2024, and yes, it has been a little bit sideways to down lately, but I think that this performance that we saw here is likely going to continue this year and beyond. They have consistently exceeded expectations. So if we have a look here at the performance, right? EPS missed a little bit in the last quarter, but overall, when we come to the profitability levels, it has been quite all right. And if we look at the price target, we can see that it's now sitting at very, very good levels. So in previous times where we have seen the stock relative to a price target like this, it has led to increases further down the line. Additionally, if we look at expectations, we can see that they have been creeping up slowly but consistently, and that is certainly a very positive sign. Well, why has all these things happened? Well, um, the company integrated approach from wellhead to export dock provides multiple avenues for growth and margin capture. And one of the things that allow them, because if you see this trajectory here, even though it was steep was pretty consistent, they have been able to put around 90% of their contracts on a fee base with strong hedging positions. So that enabled them to mitigate much of their commodity price exposure while maintaining the upside if prices rise. Now, in the meantime, they have put in place strategic investments in processing plants, pipelines, and some of that is going to be very important fractionator plants that basically enable them to get two different products out of one single commodity. And this was received by the market as very high quality in the Permian Basin, which, as I mentioned before, is a high quality location for them. So with all those things combined, at the beginning of the year, they announced that they would increase the dividend in 2025 to $4. So we can see that the dividend has stayed pretty consistent, right? So they had to cut it back in 2020, but it's been slowly coming back up. And that will be paid during the month of May. And my assumption is that it's going to draw investor demand. Because, first of all, this is a 40 billion market cap, not the typical market cap that I look for in a long, but I do see things that are going to drive interest from investors. One, I mentioned already the dividend, but also the normalization of the price as the fundamentals keep strong, and the also upcoming improvements in the business as well. So this year, the company is expected to see a significant increase in performance. There are several reasons for that. First of all, the completion of major projects. I mentioned the fractionation and NGL pipeline expansions. Those things, those projects, the completion is projected to result in substantial increase in adjusted EBITDA, which is again validated by the decision to increase the dividend. The expanded infrastructure will also allow them to better integrate their operations, leading to cost savings and operational efficiencies. And being focused in the Permian Basin, one of the most prolific and cost-effective oil and gas productions, I think all things being equal, either was an increase in, for example, demand by the market in natural gas, um, which we expect overall due to the macro factors that I explained before, would be very beneficial for them. Um, but also their improved financial situation has allowed them to reduce their debt and improve their leverage ratio. At the moment, the company has a debt to equity of about 550%, which sounds like a lot, but it's by no means one of the highest in the sector. It's about average compared to peers. But obviously, we have more catalysts there, right? Which the market is expecting to take place, such as rate cuts that could potentially take place over the next few months. That would certainly have a very positive impact for a company like this. In the meantime, with a combination of higher EBITDA, improved operational efficiencies, and reduced capital expenditures, which is something that they have disclosed, they have spent quite a bit of time working and spending money to build that operation, but that's now coming to an end. All those things are going to contribute to increase adjusted cash flow. Now, while the company capex remain high in the near term, they're not growing, right? But the balance sheet overall is pretty strong. So if we have a quick look here, we see that revenues, while they took a hit in 2023, they're back into growth. And this year, they're expected to grow by 40% in tandem with earnings as well. Now, knowing that the company is expecting to have increased profitability, you would assume that we would likely be looking at an even higher earnings growth, knowing that. But to me, that signals that management has actually been quite conservative in their assumptions. To me, that signals positive surprise down the line when they report on the 1st of May, which is pretty soon. And if we look at, for example, the balance sheet, we see that important items such as accounts receivable, remain pretty stable. Inventory healthy, is not bloated or uh, showing any signs of overcapacity. So all seems pretty well balanced. So in terms of risks, there are a few things that we'll have to keep an eye on. First of all is any potential increases in capital expenditure. Of course, any kind of like project delays and cost overruns would have a negative impact too. It's not something that we want to see. And we'll have to pay attention to the commodity prices. Well, these guys are well hedged and have upside risk. Downside risk is not going to be something positive for them. They are protected for it, but um, it's not going to be positive for the stock, and that is a little bit hard to predict at the moment with the current geopolitical situation. Demand as well is something that is important by the market, right? So I've taken a few snapshots here just to illustrate the point. Um, so this is the performance in terms of price return of Targa in blue here, in line with the rest of the sector. Here, I would just mention that there's one more ticket that we would include, which is Kinder Morgan, which shows a very similar performance on both valuation and price. So I excluded it to make the chart a little bit clearer. But you can see that in terms of the price drop when the market correction took place, Targa was one of the stocks that took the highest hit. However, if we look at this from a valuation perspective, it still remains, again, in very similar uh, valuation to Kinder Morgan as one of the leaders in the sector. So all things being equal, we get a much better price for a market leader, uh, assuming that we go to we go back to the mean, because the market at the moment is telling us this is a snapshot from the Commitment of Traders report, and it's telling us that in terms of the net exposure of traders in the market, the exposure has been long since the beginning of the year. And yes, it has eroded a little bit since the end of March, but it's certainly in a much better place compared to other oil products. And in the meantime, the company KPIs show very positive volumes, which is the key factor here for them because they process the raw materials. What's important is how much volume they process. And you can see that that has been increasing steadily quarter over quarter, which again signals the improved capacity and capabilities and efficiency that the company is at now. So other few risks to consider are regulatory, environmental, but again, we're I'm not particularly concerned about those, knowing the current administration is quite pro-drilling, dry um, drill baby drill, right? That was the comment from President Trump. So I don't foresee any changes to regulation that could hinder the stock in the near term. I think the interest rates decision is going to be more important. And of course, being um, an energy company, the operational side is something that we might have to keep an eye on as well, especially some kind of accident overnight, some kind of failure, or even natural disaster. So the way I'm going to play this trade is going to be fairly conservative in terms of time risk, simply because there is at the moment quite a bit of uncertainty in the market. But at the same time, we have earnings coming on the 1st of May, which, whilst not long from here, always provide a bit of a random period. So I'll be likely playing this as a diagonal. So buying the 175 calls in July and selling the 190 calls in June. That provides me with a 90% return, achieving $190 price target, very achievable from current levels, and could be a lot more, close to 3 times after the June expiry, assuming that I restructure into a vertical. Hope you enjoyed the video. See you soon.